Hi, I'm Colt Parrish, a real estate agent here in Cheyenne.
And I'm Chris Edwards, a mortgage lending professional here in Cheyenne. And today we're here to talk to you about the first steps you need to take to secure your first-time home buyer's loan.
If you're already here, then you already want to buy a home. We're just here to give you the tools you need and the information you want to make an informed decision. Get to it. So let's talk down payments.
Yeah, down payment is generally the biggest myth, 20%. The federal funding that we have available between the USDA, FHA, VA loans can get those down to 3%, sometimes even 0%.
0%. What kind of loans want 0%?
It varies, but that's why getting with a mortgage professional like myself will really help you navigate those waters. When you're buying your first home, we can utilize FHA, which is a specific program based around first-time home buyers, trying to get people into these homes with a lower down payment of 3.5% or different percentages with different other programs, such as the VA, which helps out our veterans and our active duty military and their family members, their immediate family members.
Yeah.
To get
family
loans.
members too?
Wives, spouses,
okay.
Surviving spouses that still hold VA benefits.
You'd be able to tell someone if they're eligible for all these programs, the VA, the FHA,
Yep.
USDA.
Exactly.
And what is the USDA?
So USDA is based on rural properties. So think outside in Cheyenne, outside of the city.
Okay.
You get into the rural properties where you have 5 acres and a house, that gets into our rural properties.
And that's based off what the city decides is urban versus rural.
Yes,
right?
exactly. How they classify it.
And what does the USDA loan, what's the advantage of that versus conventional?
It's a different form of conventional. It's just a separate program where we can get down to the 3%, the 3.5%, trying to get people to move outside of the urban areas and into the rural areas.
Okay. So if you wanted to move into the rural area, you didn't mind a little bit of space between you and downtown, then you could possibly get a much nicer down payment using it.
Absolutely. Yeah, there's a lot of different options in these loans depending on what you have available to you. So with your FHA loans, that is your first-time home buyers administration. It's the U.S. government trying to back some loans to get lower down payments to get people to be able to afford that. In a housing market where you're looking at houses at $500,000, 20% of that's $100,000, and there's not a whole lot of young people that have $100,000 sitting in their bank account.
No, not reasonable.
No, and so to combat that, the U.S. government gave us the FHA, access to FHA for your first-time home buyers, that they can go in at 3.5%. You live in that home, you stay there for a few years. When you go to sell that home, the profits from that home, generally speaking, will get you above your 20% on the down payment on your next home.
So it's backed by the U.S. government to get you into the home market.
Yep, to assist you to get into the home market, and then you can take it from there and you have your equity from the first sale and you'll carry that over into your second home.
Okay. And I mean, the dream is that everyone owns their own home, but why is that good for the government?
Well, it's good for the government in the aspect of income taxes, and if people are buying houses, the economy's going up, right? People have jobs. You have to have a job to be able to afford a home, to be approved for a loan.
Yeah.
So people are working, people are owning stuff, people are buying things. That helps our economy.
So it's just kind of not a stimulus, but like a money shot into the economy to help everybody have some forward buying power?
It is and it isn't, right? They're just allowing you to borrow more money. With 3.5% down, they're not covering 17 or 16.5% for you. You just didn't pay that 20%. So when you don't pay that 20%, you carry additional mortgage insurance to cover that portion of it until you get down to your 80%.
Oh, okay.
So that's where we get into our loan to value discussion over the equity that you build in your home over time.
FHA, who qualifies for that?
So your FHA is going to be your first time home buyer. So anybody who is buying a home for the first time or hasn't held title in 3 years.
So this resets after 3 years? Is that 3 years of owning a home, or?
Yep, it's 3 years of not holding title or owning a home at all. So you had to be renting for 3 years or longer. Then you are you're reopened for the FHA, which gets you back in at the 3.5%. Now, all of these different programs that we have are all going to be open to everybody, right? You can apply for any of these, you can be approved for any of these, but you have to hit the specific marks. Some of it's based on your income, based on how much money you have, based on your debt to income ratio. So we talked about that earlier, and we'll get a little bit deeper. That's the amount of debt that you carry, your credit cards, your car payments, your rent every month, divided by how much money you bring in.
Okay.
So it's all of those debts versus what you're bringing in gives us a debt to income ratio.
So what qualifies as income in this situation? Is it every source of money, or is it only from your job?
So it really depends on what you need to qualify. You can put in all the money that you need. Sometimes you don't need to show that you have the second job at DoorDash and get a little extra money. You don't need that to approve. Some people may need that to help them get approved depending on what they're making at their other job. So that's where the loan professionals really get in and do their magic with all of your information.
Okay, so you'd be able to get with somebody and tell them what their debt to income ratio needs to be and then how to reach that goal.
So yes, so once I take in an application and I'm able to, we do a soft credit pull or a hard credit pull, depending on the circumstances for the people. Are you like, hey, we know you're gonna get approved and we're ready to move forward with this loan, or are we out kind of shopping and trying to figure out what we're getting approved for? Okay,
and just what is the difference between a soft and a hard credit pull?
So your hard credit pull will affect your credit, soft credit pull doesn't affect your credit.
Okay.
So, but you have to do a hard credit pull to get an approved qualification.
So you only want to do the hard credit pull one time, just when you're actually deciding to go in.
Yep, when you're ready to go and get approved, when it's fully ready and you're ready to get approved for that loan. We have a property, right?
Yeah.
I can't approve you for a fake address. I can pre-approve you for $500,000, but I can't approve that loan without knowing the property, the cost of it, everything else.
And that's important for when you're searching for a home. A pre-approval for $200,000, that's great, but you can't present that to your selling side because it doesn't have the address on it. It's maybe for not the right amount of money. That's what you do the hard credit pull, to get the address on there, to get an actual pre-qualification.
Yeah, and that's the benefit of the technology that we see these days, is that I can take you from a pre-approval to approval within 30 minutes.
Wow.
Even on the weekends.
Hell of a turnaround.
So yeah, we can make that jump really quickly. Once you're ready to put that offer in on that house, we're good to go.
That's really important too, because when you're negotiating and you have multiple offers come in, if any of them are not pre-approved, or if they don't have that approval letter from a lender, they get swept under the rug. Nobody cares about them because it's a fake promise of money.
Yeah, and nobody's been able to approve that you could have those funds.
So being able to take that turnaround super fast, you go from shopping, this is how much you can theoretically spend, to, okay, this is the amount you're approved for, this is a receipt you can give somebody.
Yep, and then you can walk in and say, hey, now we're approved to buy this house, and here's the offer.
And we can negotiate from there, but you already have your price there. The trick that we kind of do with real estate too, we ask the lender, say they're pre-approved for $300,000, but they want to make an offer for $275,000. You ask you to only approve them for $280,000, then we can take that, show them, be like, hey, this is their best offer. and then there's negotiation there. And
Absolutely.
if that's not enough for them, we come back to you again, right? Would that
Yep.
be another hard credit pull if we asked you for another letter?
No, nope. No, it wouldn't.
So we just, that one hard credit pull,
Yep.
and then we have all that negotiating power.
Yep. Once I have the hard credit pull, then the letter is just the letter.
Score.
There we go. So let's talk about our credit scores.
Okay. What is a credit score first?
First of all, at the very beginning, your credit score is basically a grade of how you handle credit. How do you pay back the loans that you've taken in your past, and how much do they trust you to borrow money?
Okay.
They put it in a number. It's between, generally 3 and 850 is your very top, but there's a whole range in between there, and people can be everywhere in that range and approve, not approve. It really depends on what brought your credit down or up, right?
Okay, so what are some of the things that bring credit down?
So bringing credit down, the biggest thing is not paying your bills. Whether it's a credit card that you got and forgot about and let it go all the way to collections is the worst case.
Yeah.
It can also affect it when you're not making your monthly payments, because that's ultimately what they want to see. They want to see that you're responsible and able to make the payment of this large mortgage payment every month on demand. So when we don't make our cell phone bill every month, and every other month we pay it, and we're kind of like, I'll catch up, I'll get there.
You're spotty on your reliability.
Yeah, because you're spotty on your reliability, and they can't trust that you're paying all of your credit on time, or all of your debts on time.
We've all made mistakes. So, I mean, I've missed bills before in the past. Is that just me and I can never buy a house ever?
100% no.
Okay.
So that's the good part about credit, is it's a report card, but just like a report card, if the season's not over, the school year's not over yet, you have time to fix it. You can fix your credit. You can pay off old debts. You can make deals with old creditors and get those things written down, and we can clean up those debts, because a lot of us are carrying debt, especially these days.
I know that I don't know how to do a lot of that. Would you be able to help me do that?
Absolutely. And that's part of the mortgage lending help, is that we're able to look through that. When we go through and we pull a credit score trying to get you pre-approved, you will not get a letter from me that just says you're not approved, and that's the end of our conversation.
I've gotten that from other people before.
I've gotten those before too, usually with cars.
Yeah.
When I was younger. But that's not how this business is run or should be run. This is the largest decision that anybody will ever make the largest purchase anybody will make in their lives, or most of us will make in our lives, is our home. So it's a very important thing, and it's important that you understand the terms of your loan and what it really means.
Okay. We talked about interest rate earlier. Can you give me, in like the simplest terms, what is the interest rate? Why does it matter?
Yeah, so the interest rate is the APR, the annual percentage rate of what it costs you to borrow the money for your mortgage. So yearly, you're gonna pay that number, 4%, 7%, 6%. It's kind of all over the board right now. And it has a lot of people scared. So to use some numbers, if you were to borrow $300,000 at 4%, the monthly payment on that might be around $1,400.
Not bad.
That's not too bad.
For a $300,000 home?
For a $300,000 home. Now, a $300,000 home at 7%, that payment may look closer to about $2,000.
And now we're getting into the realm of, I can't afford another $600 a month.
Absolutely, for some
number.
people. It can be. And so your interest rate plays a big part in that, and your interest rate comes from all of the other portions that we've been talking about. It's your credit history, it's your debt to income ratio, it's all of those things added into this interest rate.
So an interest rate's not set in stone. If somebody hears it's a 7% interest rate right now, it could be bigger for them, it could be smaller for them.
It absolutely can be. So that's why you want to get through this process as quickly as possible. Once we find the house, we locked on the house, right? We know what house we're getting. Now we need to get your loan sorted out and lock your loan and lock your interest rate on the date that's best suits for you, because it changes on a daily, hourly basis.
So, you know, a good interest rate coming across, say like 5%, 5.25%. I know it's been there recently. It could change tomorrow. How much could it change by?
Well, it can have some pretty drastic swings, but it's hard to get. I don't want to get bogged down in the changes, right?
Right.
It's an ever-flowing chart that's kind of here, that's up and down. You know, okay. It can go up, it can make big jumps up, and it can make big jumps down. It's all based on the economy and based on the federal interest rates, and the rate cuts that we saw this week can definitely help. But it can also cause the inversion and create rates to get higher. So it's important to keep a tone on those rates, and your mortgage lender should be able to help you get you locked in at the rate that's right for you.
Right, and you have the most recent numbers, right?
Absolutely.
And that's, you know, my problem too, is I get the numbers from lenders, but it's always a couple of days after a change actually happens.
Yep, and generally that's the hardest part, right? I've been asked several times, like, are you sending out rate sheets? And I'm like, I get rate sheets on an hourly basis.
How many rate sheets do you want a day?
So yeah, that's kind of the, like, I have access to them hourly. Like, it's kind of when I want to pull them. So when do you want it? What do you like? It really kind of, it's deal dependent.
So it's deal dependent, but it's also property dependent, right? It's
absolutely.
Like commercial versus residential, urban versus rural, land versus construction.
Absolutely. And that's where you have all those different options. And then we have to add in the world of different financial options that everybody has.
Because as a mortgage loan officer, you don't deal with just one lender, you have a bunch of them that gives you all these different options, right?
Yeah, as the mortgage broker side of things, we're working currently with 17 different lenders to shop different rates and different programs and different ones that just these lenders have. You know, one lender may have a specific program for refinances or for first-time home buyers, trying to pump that up.
So all these people are like running their own specials, like convenience stores.
Yep.
But you have all of them coming to you, telling you what they specialize in.
Yeah, well, so I have access to be able to put all of my information and shop all of those at current time.
So to wrap all this up in a bow, what do we actually need to do next? If you're here, sitting here wanting to do something, what's the first step?
If you made it this far, the next step is giving Colt and myself a call and getting you pre-approved. That is the very next step. Colt can start working with you on the options of what you're looking for, what you're shopping, your wants and needs.
Wants versus needs, big thing there.
Very big.
And Chris can help you with figuring out your actual budget, what your debt to income ratio looks like, how much your credit needs to improve, or if you can just go for it right now. And he'll get you your budget figured out. I'll figure out what we can do with your budget.
Yep, and there's a link down below to reach both of us, or you can give either one of us a call. Don't forget to hit the 2 links below, get your application for your home loan filled out and your contact information for your realtor filled out, and we'll be in contact with you shortly.